Hi, everybody.
Okay.
Hi, you guys can say hi to me.
Hi.
Hello.
Hi.
You guys can say hi.
Hi, everybody.
Hi. So it's a different environment than we were in a couple of years ago. So I want to start by just running down the line here and ask, what is the core difference for you guys between investing now and investing, say, in 2020, 2021? Villi, you want to kick us off?
Sure. I mean, a few things have changed. The main one is the cost of capital has gone up. And so I think investors are much more discerning around what types of risks they take and how much capital they're willing to commit before you reach the milestone you're looking for. And so I think that's changed. I think in general, capital is more scarce. And so we're always thinking, is this company likely to see future financing? How should we think about capitalizing this company? So I think in general, the risk aversion of investors has increased. And outside of the more exciting areas like AI, for example, I think we're just being much more careful in deploying capital.
What about for you, Pegah?
All right, I'll say it. I mean, it's somewhat of the same stuff, so I'll stay on some other topics. I think one of the things that's different is you can't go spending $10 to get $1 of revenue. I mean, money is not cheap, so you just got to be much more thoughtful about where you're spending the dollars, if it's on R&D or revenue. And I think that's something we look for. We always have looked for, but even more so now, because even the best founders, still have to think about that. But I will say what hasn't changed is if you're a founder who has deep conviction, who has unique insight on a sector, you can still get money. So it's not about getting money. It's about, are you being thoughtful about the fundraising that you're doing on how to survive whatever this duration is, whether it's 6 more months, 2 years, really choppy for maybe 2+ years. And so that's the environment. You just want founders who understand that it's going to be different and can adapt to that.
And it sounds like what you're saying is money is out there.
Yes.
It's out there.
We have a lot of it, so.
What about for you, Brett?
Yeah, I guess I would reiterate both those points. Capital is scarcer, and capital efficiency is way more important now. So at once, you should expect less capital and expect to make it last longer. I guess what strikes me is what's the same about early stage, though, is that, I guess I say, timing markets is for liquidity. It's not for starting companies. So it's as good a time as ever. And maybe it's helped select. If you don't feel like you really want to start a company now, maybe you didn't really want to start one in the first place.
And one of the things it sounds like you're all saying is capital efficiency. What does capital efficiency, practically speaking, mean to you when you're looking for it? What are you looking for? Do you want to start, Villi?
Well, you have the product development. So what type of investment is required to validate a thesis, right? And so, the clarity of thought that a founder can provide for what they want to build, for which customer, for what use case, what problem they want to solve, will dramatically impact the efficiency with which they build that product. So you care about how long it's going to take to take an idea to market. And then once you have an idea to market, can you build an efficient customer acquisition model where it allows you to build a business and scale the company without consuming, a massive amount of capital? And when capital is cheap, we get more loose on that requirement to get your money back within a reasonable time frame. Now the capital is more expensive. We're looking for just much more efficient businesses that allow you to reinvest into customer acquisition as opposed to using external venture dollars to scale the business.
I would say, look, when my first IPO I worked on was Google. And people forget, hey, yeah, look, we've been all drinking
Casual.
from the fire hose of just ample capital at everyone. And if you go back to, those times, Google just raised one A round, and that was enough. And we haven't seen that many companies like that. And I think it's because some of it has been because there was a lot of capital. You could just plan for, hey, I'm going to use up this round and go for the next round versus really being, what's my 20, 30-year plan? And if I don't have, don't time the markets perfectly and optimize for this dilution and that dilution, how do I spend money to become the winner? And the best founders that are really, going after sectors that people misunderstand are thinking about that and thinking about, can I grow efficiently? And sometimes it's not about growing efficiently. Sometimes you have to raise more to actually showcase the product market fit. So I think it can be different, but I do think there's going to be an exciting new breed of founders coming out now because they're working in an environment where they have to think about that. And I think it's not just founders' faults, right? That's not what people were looking for a few years ago. If you were really efficient and didn't raise, your other folks, maybe some of your investors would be like, how come you're not getting up rounds and how come you're not raising more? So some of it is just, I think we're going to see some of those great founders coming out of these years.
And you were nodding, Brett.
Yeah. I mean, I agree with all that. The other distinction I would make though is that it's very coherent, like what capital efficiency is post product market fit, and something like a burn multiple with how much you're spending to add on additional revenue. But pre-product market fit, there's not a metric that's as clear. And so really, and the path of product market fit, it's as undeterministic as growing a startup is. The path of product market fit is certainly more less deterministic. So when you're early and thinking about capital efficiency, it's kind of like a number of outs. Like how much time do you have to figure out something that's going to turn that corner and convince future investors that you're on to something.
Yeah.
And the leaner you are, the more time you have. The more shots you have. Yeah.
And then as, we're talking about capital efficiency, and it sounds like that is something that does put pressure on founders. Are there any founders in the audience? You can just raise your hand. Okay. So there are quite a few of you. What kind of advice are you giving to founders in this time? How are you sort of talking them through this moment where capital efficiency, frankly, I think no one would argue with this, is much more important than it was before interest rates started going up? You're having a thought, Pegah.
I mean, Wesley and I raised the fund last year, and it wasn't the easiest environment to raise. So I feel like I've gone through it in some ways. The number one thing I would say is there is money out there, but you have to stand out. You have to have a deep conviction in something and get people to believe you. So you have to really, and it's not going to be obvious. You look at a Canva that everyone's looking at now. I mean, Series A, Series B, it wasn't very obvious to people. And so it's okay if you have non-believers, but you have to have, I think, deep conviction and really have a unique insight that you can look scarce to everybody else. Like, you can't just say, oh, we're going to grow revenue from this to 3x. Like, this isn't, that's not the scarce companies that are going to get, rounds right now. So I would say stick to those. Just be choosy about your investors because it's a marriage. It's not just about the money. And I know it's a tough time, so people might accept money from a lot of different places. But I would say the deep conviction in this, 50-year plan is the big thing. And I would say the other thing is back to what you were highlighting. The founders that are coming out now, this is why it's so exciting for VCs. The founders that are coming out right now are in a lot of ways running into the fire. So they have to have that conviction so much more than others because it's not the easy choice anymore to just start a company, right? And so the founders that are doing that, and you just might have to knock a lot more doors. It's just going to take you longer. Don't worry about it. It doesn't mean the fundraising is not going to happen. You just have to find the right investors that are going to believe your vision of the future.
You're nodding, Villi.
Find believers. Don't try to convert and convince VCs into becoming believers. That's not to say, again, it's not to say you shouldn't try, but ultimately you're looking for somebody who believes in you and believes in your idea, already is predisposed to it. You're not pushing the boulder uphill, which is just it's hard to convince people that are already negatively predisposed.
And you nodded at Pegah's point about scarcity, kind of proving to someone that you have something that very few people have that's truly scarce.
Yeah, well, what's strange about it, because scarcity struck me both in terms of, what the startup has accomplished, but just like back to the capital point, because if you were a founder in 2021, what became weird about the market then was the capital market became kind of continuous. So for every level of de-risking or progress you made, there was an incremental buyer to give you more money. And now it's gone back to its normal state in venture, where you get seed capital and you either knock it out of the park and you're a strong candidate for a Series A, or there's nobody around the table looking to give you more money.
Yeah.
So
that sounds like a scary prospect to be at a table with no one.
Well, I mean, I guess not nobody. Certainly, your cap table might work something out if you're turning a corner. But I think that also, again, it selects for the right type of people. It's scary, but like everything in industry, it's high risk, high reward, right? And so, wanting to the motivation to accomplish and hit that bar, I think, is also invigorating.
Speaking of high risk, high reward. Who here has been to a conversation that mentioned AI? Raise your hand. Honestly, that is not as many as I was expecting.
They're just tired.
They're just tired.
Yeah, that didn't seem
They're just
accurate.
had enough.
Seen it talk about AI.
Well, we're going to talk about AI
I didn't raise my
again.
hand, and I have.
You have? I have
so
too.
sorry. I apologize.
But we got to talk about it. Is there a benefit to being a first mover in AI right now?
Okay, I'll take
that. Was
it.
a deep breath.
Yeah.
You were like, okay, here we go.
Look, in some areas, yes. I think it's like hard for people to know, and everyone can say they have deep conviction with where everything's going. And yeah, everyone knows the power of it, but we don't know how long it's going to be. Is it going to be like the mobile wave that happened really fast, or is it going to be like internet that took longer? And I think everyone will agree this wave seems so much faster. But I would say if you listen to Adam from AWS, who's a friend, and we're in, probably step 3 or 4 in a 10K race. And I think that's very true. And so, yes, are there going to be great first movers right now? Yes. But I think people who are, going slower, but like start taking, go steady and go longer could also get way far. So I think it's the huge value I don't think the inflections haven't come yet. And the best companies are going to come, I think, still.
Yeah. I think it depends. So for the service providers, the ones building the large language models, without a doubt, there's a first mover advantage. It takes a lot of capital to build these. It's going to be really hard for anybody to catch up, absent some scientific breakthrough, which without a doubt, OpenAI had scientific breakthroughs that accelerated what we thought state of the art was probably by 5 years. So absent some scientific breakthroughs, without a doubt, I think in that space there's a first mover advantage. The applications, the tooling and applications that is going to be built around these large language models, I don't think there's a first mover advantage. I actually think there's probably a first mover disadvantage.
Yeah.
And so I think provided these large language models are real, and I'm 99% sure this is going to be a 20-year cycle here that we are just starting with. It's going to be very exciting. I think there's going to be a decade of opportunity or more to build tooling and services, applications on top of this stack.
Yeah.
I don't know. I guess I disagree. I think the first mover advantage for LLMs exists, but is thin. Transformers are not that old, like 2017, and absolutely the capital and there's a capital and data advantage that could stick around, but I don't know. I think there's a lot of room for shoes to drop and the sector to continue moving very fast.
And I would say something when people are thinking about, the first order kind of tools around AI, but think about who benefited from the mobile wave. Outside of, Apple and some of that, it's like you had companies like Uber be created out of that. It was not a mobile company, but it was taking the benefits of what existed because of that industry and saying there's going to be new demand for things that people didn't think was possible. And I think right now we're in that phase where we're thinking, okay, what can we use our phones for? But the next order of things that are going to come and the huge value creations are going to be people who reimagine industries in a different way versus supplementing the things we're doing now.
And and what's strange now is the people who have a lot of money and access to capital. I feel like this is in the history of the innovator's dilemma. The big companies are paying way more attention, and it's way more urgent than any other place where they've been innovated.
Let me add to this, 'cause
Sure.
I think this is an important point. I think if you look at the migration from client server to cloud, it put all of the incumbents in a disadvantage. And maybe a couple of companies made that migration successfully. Adobe and Microsoft come to mind. I think what's different now is that the incumbents are just as well positioned to take advantage of this new wave of AI innovation that's coming as startups. And so, I think we as VCs think about moats like, can you build a better solution than the incumbent? Because the AI in and of itself, I don't think is going to be a differentiator, at least at the application layer. And so I think I think we're all like trying to figure out how to think about the space right now. And I think it's moving fast. There are going to be a ton of opportunities, and I think it's going to be exciting for a while.
And back to the point about like raising, if even whether you're AI or not, I think it's an exciting time because there is this uncertainty of people don't know 100% how it's going at what speed. You could argue, okay, when it was about vertical SaaS and people, okay, now had a playbook and they kind of knew how it was going to play out. With some of these new things, people don't know. So you as a founder could have, deep conviction on this is the way you think it's going to be, and you can find believers who will believe you on some of that stuff as well.
Yeah. Well, I mean, in software generally, you could the history, like, there's all these software applications where, as it became easier to build software, domain expertise and understanding the segment was more important than ability to build software. And I think the same is going to be true to an even greater degree with generative AI in applied use cases.
Well, the other thing I've been wondering too is, have you seen AI yet, all of this hype, all of this interest, translate to investment that's actually moved the needle on the market yet? Because I think the data isn't showing it yet, but I'd be curious what you're seeing out there.
You mean from an exit point perspective?
From an investment perspective.
I mean, Databricks just bought Mosaic, right? So that was probably for the timeline. I think you're going to see. It's going to be interesting. Look, like I said, it's not. I do think there's going to be a lot of large companies that are looking to get on the AI wave faster, and they're not looking in the same way from multiples of late stage companies, software multiples at 7 or whatever. They're not thinking about it those ways because for them, they're thinking, is this going to transform my business? And so they're not going to be measuring it from a sales multiple. And so I do think you're going to see some substantial exits, but at the same time, you'll see a lot that they can just do themselves. So I think, are you that scarce mobilizer for some of the potential acquirers? I think that's going to definitely, you'll see more of that, the types of deals you saw today.
And to this point about scarcity, it's time to talk about other sectors, right? Who is well-positioned sector-wise right now, and who maybe is going to struggle? that was a deep breath. Go.
I think it's really hard for me to even predict at a macro level. I would say at the startup level, I think, especially kind of the SaaS universe, has gotten way oversaturated. It's extremely competitive in every subsegment of the market. Vertical, maybe there's still some vertical opportunities. Set aside the AI for a second, because I think AI is a differentiator. But just your average SaaS, sales, marketing, HR app, I think that's going to be a really tough place to be, mostly because it's extremely competitive. And that's just, you're going to have to find another dimension to compete on. Maybe AI is that, but I am really hesitant to invest at your typical SaaS application that we were looking at. and investing in for the last 10 years.
It's not just the competition. It's also that when the market was way up, investors kind of reset their math on the range of the outcome distribution in terms of how big some of these SaaS companies could get, and I think that they're gonna tighten up and ground on current public revenue multiples, and so that will cause venture investors to conclude some subset of these SaaS businesses are not actually venture scale.
And I ask because, I think about fintechs, right, which by definition require a lot of access to capital. That said, though, are there any other sectors beyond AI that you think are particularly well positioned right now?
I think every sector. Look, I think technology is still like, look, the narrative used to be software's eating the world. I think arguably we're past that. Everyone's like, yeah, duh. Like every company's going to have massive tech component to them, and you're seeing some of the traditional industries starting to do it. Like you have car manufacturers now building app layers and all that stuff, right? And so I think technology's here. It's getting bigger. AI is going to accelerate it even more. I just think there's boring spaces that are still ripe. I just think you have to have a different perspective where that sector's going. Look, we invested in a company that does transfer taxes, like not thrilling, like it's sounding from me like it's like taxes. Who wants to do their taxes, right? But companies have to do a ton of that, and they have a global business, and they have to. So you can still find a lot of industries that, especially with AI, can do it way more efficiently and don't have incumbents, because that just has been a services business and not a tech business as much. And so I think I wouldn't obsess about sectors as much. I do think back to what you said. We invested. Fintech is like on a downturn, right? Arguably on multiples, but we invested in multiple fintech companies because they had a unique perspective on how they're different than the sector and what the sector's getting wrong about fintech. Just because you add an app and you're still like an insurance company doesn't make you, have higher multiples than insurance, right? So it's like, what's the unique insight? What are you getting that the market's not getting? And what does your technology enable that the incumbents can't really compete with? And I think that's the one thing. Try not to go after hype areas if you don't actually have deep conviction in that space, just to say everyone's investing there. We're investing in a lot of non-AI spaces. We're investing in computational bio. We're investing in, like I said, a lot of these spaces that don't seem to be the hype right now.
And we're already out of time pretty much, but I want to play a quick game with you guys that's going to be a little more lighthearted than some of the other stuff we've been talking about. It's going to be a quick word association game. I'm going to give you a word. All right, you're ready. I'm going to give you a word, and you give me your first inclination.
Is it more points the longer the word is, or no? No.
Yes, I will count. You'll get a special prize if you come up with the longest word. AI, Villi.
Exciting.
Pegah.
Thrilling.
Brett.
Excited.
I like, yeah. All right, founder, Villi.
Hard work. 2 words.
Pegah.
Mission.
Brett.
Formidableness.
All right, last one. 2023, Villi.
A mess.
Okay, I'm going to steal it. Shit show.
Brett.
Rebuild.
Thank you all so much. Thanks, guys.